We are joined this morning by Chicago Fed President Austan Goolsbee. Austan, good morning. Such is the world we live in that what I thought was the news I was going to ask you about has changed in the last hour to be different news I'm going to ask you about. And I want to start directly with two tariff announcements from the president, one that appears to be directed at Apple, another 50% tariffs on the EU. And I'm just wondering how you as a policymaker react to this kind of changing environment when it comes to big economic declarations from the White House.
Well, we had the big Fed Listens event last week at the Chicago Fed, and a whole bunch of folks from the district came in to talk about the economy. And the two common themes were, number one, they hate inflation, and number two, they want some consistency. The CEO of a construction company said for them, we're now in a put your pencils down moment where they just have to wait if every week or every month or every day there's going to be a new major announcement. They just can't take action until some of those things are resolved. So it's not surprising that's the environment that we have been in. But it does just heighten the amount of, it's more than uncertainty, it's the non-consistency that for bigger decisions, the businesses are saying that they need to have some idea that it's going to be a constant that they can count on when making the investments.
So the uncertainty is one thing. What about what's being discussed? For example, a 50% tariff on imports from the European Union. Is that a big enough thing to be a macro factor to affect policy?
That sounds like, I mean, to go to 10% was going to be the highest tariff rate that we had on the world in 90 years. To go to 50% is a completely different order of magnitude. Now, at the Fed Listens event, and when I'm out in the district, here, the Chicago district covering the Midwest is the most export and import trade tariff exposed district of all, including 4 of the top 7 highest exposure states. As they look at tariff rates that are that high, that would be really scary for the supply chain. But there was at this event an expression that maybe this is just a stepping stone, and that on the back end of this thing, we could get some new deals, we could open up some new markets. Maybe this won't happen. But if every few weeks we're going to get new and larger tariffs, there was a lot of anxiety that it's going to disrupt the supply chain and kind of take us back to an environment of rising costs like the ones we experienced in 21, 22, or even with the supply disruptions of 2020.
So not to be too reductive about it, Austan, but what does it mean for policy for you when it comes to, am I willing to cut? Am I willing to hike? Do I need to stay the same? How do you put all of this into the hopper and come up with essentially what is a binary decision for you?
If they did it's sort of 2 parts. In the short run, we got to just wait for the dust to come out of the air. If you throw a lot of dust in the air, everything's always on the table, but I feel like the bar for me is a little higher for action in any direction while we're waiting to get some clarity. And then over the longer run, if they're putting in place tariffs that have a stagflationary impact, which is to say they slow down output by raising the cost of production while also raising prices, then that's the central bank's worst situation. That is a stagflationary where both sides of the legal mandate get worse at the same time. So I think we'll have to see how big the impacts on prices are. I know people hate inflation, and they've expressed that many times.
Yeah, Austan, a put your pencil down moment, the latest put your pencil down moment. I would think that the pencils might have already been down from what has happened since April 2nd, whenever it was. And my question was, I don't know whether we've seen the negative effects front and center from what you would have expected at that point. And I'm wondering.
I think that's an interesting observation, and it kind of goes to I've said on this program before, Remember, imported goods are only 11% of GDP in the United States. So there is a sense in which if we don't go wild, if it doesn't jump out of its 11% lane, it could be like 2018 where we had tariffs. They impacted the directly affected industries, but they didn't have a big macro effect.
I just wonder, is it still coming, or could this cause it? Where is it? Is it still coming? Are we vulnerable to a more shock that would definitely put us there, or is it it's going to keep the economy just keep on going?
Yeah, well, I hope it just keeps on going, and that we come back in a few months and say, hey, it was only stayed in its 11% lane. It didn't have that big of an impact. My only fear here, I shouldn't say my only fear. A fear here is, remember, the data come out with a lag. The price data come out with a 1 month lag. The GDP data come out with a 1 quarter lag. And so something might have already happened. And it's like watching last night's game on replay the next day. If you already know the outcome, you're not feeling that great about it as it's going along. So if we get multiple months like the last month where inflation is not accelerating, then I would definitely feel a lot better about it.
Hey, Austan, all of this news happening this morning, so we've completely changed the focus of what we would have been asking you about. Yields are down slightly this morning, but those higher yields that we've been watching all week, I just wonder how big of a concern that is for you, how big of a concern it is for the business leaders that you've talked to along these lines. If rates are going higher, regardless of what the Fed decides to do or not do, what you think about losing control of the long end of the curve, and what you think about what that means for the economy.
Yeah, each of those is critically important. Now, the market determines the long rate conditions, as you say. The Fed, we're setting the Fed funds rate. We're looking at the short end. The long end are the conditions in the economy, and those can be causes or those can be symptoms. To the extent that the conditions are getting tighter on the long end, that does affect investment decisions, consumer durable purchases pretty directly. So I would think, want to factor that in is there going to be slowdown? At the same time, if we're going to get a big fiscal stimulus that's pushing back the other way in the short run, we have to weigh off considerations like that, too.